These are smart money concepts, the same concepts big banks, hedge funds, and big institutions use. And there's a reason for that, because of how successful they are.
I'm really rich. I'll show you that in a second.
This is not your ordinary indicator strategy. These concepts go deep down to the core of how the markets are structured. And luckily for you, you can take advantage of that from watching this video. I'm gonna explain the exact formula so you can copy the style of these trades and use these concepts yourself in your everyday trading. All right, I've already wasted too much time. Let's get straight into it. Alright, where do we begin? First, we need to go over the structure of a trend to make sure we're using these concepts correctly. Then we'll go over some actual live trades to see the strategy in action, and at the very end of the video, we'll go over a secret trick to make this strategy perform to a whole new level. So to put it as simply as possible, a normal uptrend will look like this, making higher highs and higher lows. Every time a new high is broken, this is what's called a bullish BOS, or a bullish break of structure, breaking the previous high. It will then eventually lose momentum and start heading the other direction. This is very important to understand. In order for this to be an official reversal, price has to break this prior higher low, which is right here. Once this move has happened, that is called a chach, or a change of character, which can identify when a reversal is about to happen. Now, you'll see these absolutely everywhere you look if you go look at the chart right now. But what we're looking for is something extremely specific. In order to make this change of character significant, we want this previous high to be in an area of interest. For example, a supply or demand zone, or an order block. The stronger this area of interest is, the better. This will significantly increase the success rate of the change of character. Picture it like this. A kite. Yeah, it's pretty good at flying. That is like the change of character by itself. It gets the job done, but it's still a kite in the end. But if you grab that same change of character and add a strong area of interest to it, that kite turns into an F-16 fighter jet. Big difference. Once we have a change of character in an area of interest, we can expect price to start heading in the opposite direction, downwards, making lower highs and lower lows, creating bearish break of structures. Then once it comes to the bottom, it'll repeat the whole process again by creating a bullish change of character. So that's the idea behind the strategy. Very simple, but there are some specifics we have to go over to make this strategy as successful as possible. First, the most important thing is you need to locate a key area of interest. We want this area of interest to be as strong as humanly possible. The stronger it is, the more likely the chart will move in the direction we want it to. So what do I mean by strong areas of interest? Well, there are a couple things you can look for, but I'll show you the best performing ones. The first one is a liquidity grab in a key supply or demand zone on a high time frame. What you would do is go on a higher time frame, like the 1 hour or above. The higher the time frame, the stronger the area will be. Next, you want to find a very key area of supply or demand. You can find this by finding areas where price rejected multiple times, like here for example. What you want is price to do a liquidity grab. A liquidity grab is simply when price breaks this recent high or low, does a fake out, and reverses in the opposite direction. The reason we want a fake out is this. There are going to be people entering long positions of this recent break. So you know what they're going to do? They're going to set their stop losses here. So if price does end up doing a false breakout, once price comes back down, it'll hit all these stop losses, adding fuel to the fire and increasing the momentum and the likelihood of the price continuing to head down, which we can take advantage of by entering a short and making that sweet old cash as the chart tanks. Keep in mind, you can do the exact same thing with long trades, you just do the complete opposite. So a false breakout or a liquidity grab on a higher time frame is the first example of a key area of interest. The second way you can look for a key area of interest is by finding an order block. An order block is basically an area where the big money institutions like to enter or exit. These areas are high interest because usually price does strong reversals at these levels because of the amount of money that's entering or exiting, which is exactly what we're looking for. Now, shameless plug, I already made an indicator that'll show you all of this. It'll show you the break of structures, change of characters, key areas for liquidity grabs, and show you order blocks where big money institutions are likely to enter and exit. So I'm going to be using the indicator for the examples in this strategy. You can do this strategy without the indicator, but one, it will not only help you identify these key areas and let you identify them quickly on the fly, but two, it'll show you these areas you otherwise wouldn't know, like these order blocks. It's really a game changer, and I use it myself on a day-to-day basis when I trade. If you want to try it out with the strategy, try it out for a month. I'll put a link in my description. I guarantee you'll love it. So what I do when using this strategy, I'll go to the settings of the indicator and disable absolutely everything besides the smart money concepts. This will enable everything you need for this strategy. As you can see, the indicator is already labeled everything for us. It's beautiful. Okay, so let's do some live examples.
Hey, TradingLab, do you know how to double your money?
Double my... What? Is that hit rapper Eminem?
Yup, it's me, Eminem. I'm here to show you how to double your money.
Okay, kinda weird and off topic, but I guess, how do you double your money?
It's really simple. It's called Angle Trade. Look it up.
Hanker Trade. Yes, they can double your money, and it's extremely simple. They offer a first-time 100% deposit bonus. So that means whatever you first deposit, they will match that and give it to you for absolutely free up to 25 grand.
Have you heard that Hankel Trade has some of the lowest fees on the Forex market as well?
Morgan Freeman? Apparently everybody knows about Hanker Trade. Yes, Morgan, Hanker Trade does have some of the lowest fees on the Forex market. They are my favorite Forex broker. If you haven't already, go to my description and check them out, and make sure you get that first time 100% deposit bonus by using my link. Alright, let's get back to the video and go over some live trades for this strategy. Make sure you're on a higher time frame, like the 1 hour. One of the key things to look at are these low and high lines. These are the lines price needs to break and do a liquidity grab at, like I was talking before. If you wanted to do it manually, you would just zoom out on a higher time frame and find where price is rejecting or getting supported a lot. So you would make that line, and that's the line price has to do a liquidity grab. Here, the indicator does it for us. If we want to do a short, we want price to do a liquidity grab at the high. If we want to do a long, we want price to do a liquidity grab at the low. Here's a live example with the trade I took myself using these exact same concepts. The indicator already drew our lines where price has to make a liquidity grab for us. If you aren't using the indicator, you would just zoom out and see where price rejected or supported a lot. So the very first thing we look for is price to do a liquidity grab or a false breakout. Let's see what happens. Price came up to this area of interest, passed it, and rejected. So this is the liquidity grab we are looking for. Since it was a bearish area of interest, we will look for signs to enter a short trade. The next step is we need price to make a change of character. The indicator will label this for us. If you're doing it manually, just follow the guide I said at the beginning of the video. As you can see, price fell very hard after doing this liquidity grab and made a gap while falling down. This is very important, so keep this in mind for later. After that, it falls a little more, creating a change of character. This is step 2 completed. Price must make a change of character after the liquidity grab or the signal is no good. So we have 2 indications this is a good short. Next, we need to know where to enter. What I like doing is entering on a fair value gap or a gap in general. A fair value gap is simply when price falls or goes up so fast that it doesn't give buyers or sellers enough time to enter the market, which creates an imbalance in the market. Oftentimes, price will want to come back up or down to this fair value gap and reject. You can have a bullish fair value gap and a bearish fair value gap. They make very great entries and are usually extremely strong. My indicator will mark these for you, red rectangles being bearish fair value gaps, green rectangles for bullish fair value gaps. Quick tip, if you are using the indicator, I only like turning the fair value gaps on after I find a liquidity grab and a change of character, because they do make the chart a little messy. So in this scenario, this is where I would enable the fair value gaps. If you aren't using the indicator and want to do it manually, you can mark a fair value gap by taking the previous candle's wick before the big move, then taking the next candle's wick after the big move. This rectangle area is the fair value gap itself. If the big move is moving down, it's a bearish fair value gap. If the big move is moving up, it's a bullish fair value gap. Now, if you trade stocks, oftentimes when price falls or goes up super fast, it'll create a gap like the one here. This basically has the same functionality as a fair value gap. If you don't trade stocks and trade Forex or something, just look for fair value gaps and just disregard this gap thing, as these will not happen in Forex. But since this chart is a stock example, there are gaps on this chart, so we will be using them in this example along with fair value value gaps. So now that we have a liquidity grab and a change of character, I go to the settings of the indicator and enable fair value gaps. This will indicate where all the fair value gaps are automatically for us. What we want is price to come back up to a fair value gap or a gap after making a change of character. This gap right here will work perfectly, as price will most likely want to return to this point because there's an imbalance in the market at this area. Let's see what happens. Price comes back up to this gap just like we thought it would. Now, if you want to be in the trade for sure, you can enter right at the beginning of the gap, so you would enter a short right here. If you want a little better entry, you can wait for price to come up to the halfway point of the gap, so you would enter right here. I find a lot of times price will come to this halfway point and then reject. But just keep in mind, sometimes price will only come to the starting point of the gap, and if you are waiting for the halfway point, you would have missed out on the trade. So in the end, it's up to you which way you want to do it, but those are the two different ways you can do it. So price made a bearish liquidity grab, a change of character, then came back up to a normal gap or a fair value gap. This is where we enter our short trade. We set our stop loss at the high of this move, we set our take profit at the low. What I really like about the strategy is that it gives a great risk to reward ratio basically every time, which is super great. Let's see what happens. It was a winning trade. Now, just to prove to you how successful this strategy really is, I'm not going to even cherry pick charts. I'm simply just going to stay on this chart, and you can see 1, how often this happens in the market, and 2, how successful this strategy really is. So you can see once price hit our take profit, while doing that, it actually broke our low line and rejected, creating a bullish liquidity grab. So we can start looking for a long trade now. The next thing we need is a bullish change of character. Let's see what happens. Price ends up going up and making a bullish change of character. That's step 2 completed. Now we need price to enter into a fair value gap. As you can see, price created 2 bullish fair value gaps as it was going up previously. Now here's a little rule of thumb. If you want to be on the safer side, you should wait for price to come down to the lower fair value gap, so this one right here. Just know price will not always do this and will end up rejecting on the higher fair value gap. So you would miss out on this trade if you're waiting for the lower one. I usually just do the first fair value gap, so this one right here, but if you want better entries and better risk to rewards, wait for the lower fair value gap. Just know you may miss out on some trades. So we wait for price to hit this fair value gap, which it does. We enter here. You can set your stop loss right below this move or set it all the way below this liquidity line. It really just depends on your personal risk tolerance. Either or will work, but I'd recommend doing your own testing. After we set our stop loss, we set our take profit at the high of the last move, and look what happens, another easy trade. Oh, but wait, we aren't done yet. As you can see, when price hit our take profit, it did another liquidity grab from the previous high. So we keep our eyes out for another potential short. We see price make a bearish change of character, so that's step 2 completed. Next, all we need is for price to come back up to this bearish fair value gap for our entry, which it ends up doing. We enter here, set our stop loss either at the high of this move or set it all the way above this liquidity grab, depending on your risk tolerance. Set the take profit at the low of the last move. Let's see what happens. Another winning trade. As you can see, none of these were cherry picked at all. If you go look at your charts and see a liquidity grab, a change of character, and a fair value gap all in correlation, it brings in a massive success rate. Now here's one more extra little trick you can do with this strategy that performs insanely well. Instead of looking for a liquidity grab, you can use an order block. What you want is price to come to an order block and respect it like this. It needs to respect it. If it breaks through it like this with a big bodied candle, it's not a good order block. It's okay if it has big wicks going through it like this. It just needs to show signs of slowing down and respecting the order block. Once you see price respecting the order block, you can do the exact same strategy just with order blocks instead of liquidity grabs. So next we look for a change of character, which we get. We wait for price to create a fair value gap and come to it, which it does. We set our stop loss, set our take profit, boom, more easy money. Next, we're gonna go over what hedge funds, yes, the big boys who control billions of dollars in the stock market every single day, think about technical analysis. And the answer, it may just surprise you. Go check that out. Thanks for watching, and I'll see you guys next time.
Hey, TradingLab, do you know how to double your money?